Hello again. Got another Rogers Capital Management market commentary for you, where we attempt to be the antidote to water cooler wisdom, which these days seems to be that we have an impending doom coming, a bear market right around the corner. This video, I thought we'd take 4 or 5 of those claims and give you a little more information on it. The number one bear market argument has been that equities have gone too far, too fast. Market's too high. Sound familiar? Yeah, in fact, we've been hearing that since the beginning of the year, since the rebound from the pandemic in March of last year. Well, there's no doubt 2021 has been an amazing year. We're up about 20% so far. And that is without so much as a 5% pullback. We've had 51 all-time highs. And is that rare? Yeah, only twice have we had before September 50 all-time highs. That was 1964 and 1965. In fact, the all-time record in 95 is 77 all-time highs in a year, which we're on pace to challenge. So we've been hearing it all year. I guess the broken clock that's right twice a day will eventually be right. The second bear market argument is that strong earnings are just due to easy comparisons over last year. And there's no doubt that there's a good portion of that sunshine we've seen this year due to the year-over-year comparisons of earnings to a lockdown, a pandemic quarter. But the S&P earnings per share for 2021 is now an expectation of $205. That's 46% above last year. And more importantly, 26% above the pre-pandemic level in 2019. And price to earnings ratio, the valuations on the market have been steady, despite the index's 20% year-to-date gain. The third bear market argument has been that cyclical stocks are flashing a warning sign. Now, it's true that some cyclical stocks have underperformed recently. In fact, the Dow Jones average, industrial average, topped out in early May. However, cyclicals, companies like restaurants, hotels, travel, home builders, have still maintained an upward slope with the 200-day moving average. And in fact, recent underperformance is probably more just working off a furious rebound from the March lows, the pandemic lows. And we're probably working off a little bit of overbought conditions due to that rise. But overall, those conditions are bullish for the mid and long term. The fourth bear market argument has been this taper tantrum that's coming. Investor surveys suggest that folks are worried about a taper tantrum. That may be a phrase you've heard. When the Fed starts to reduce its bond buying program. Now, in 2013, Fed Chairman Bernanke mentioned that the Fed would start reducing or tapering its bond buying. And that surprised investors, and markets reacted negatively. In fact, coining this term, taper tantrum. But a couple of things. First, that was a 6.8% downturn. And remember, that's just a pullback. Pullbacks where we're supposed to have 4 every year, volatility-wise. Second thing, that year ended up with a 30% gain. And thirdly, while we're in a similar situation today, the Fed is not ready really for the tapering just yet, and markets certainly cannot claim to be surprised when that begins. We've been talking about it for months. In fact, one of my favorite Fed comments has been from former Fed Chairman Martin, famously quipping that the job of the Fed is to take away the punch bowl just as the party gets started. Well, the Fed's not taking the punch bowl away anytime soon. In fact, all signs point towards the Fed remaining accommodative. Now, the fifth bear market argument has been that the White House is going to derail this bull market. I don't think politics are a serious threat to markets in the near and medium term. Now, policy does matter, but unless there's a ridiculous mistake, this administration's agenda is likely to be a mixed bag. As we've talked about for months, stimulus is good. Now, on the other end, taxes, which are almost certainly going higher, are not so good. But that mixed bag seems to be what we're most likely to be working with. The primary driver of stimulus and the reopen, those drivers continue to be what the recovery will continue to respond to. Businesses looking for better ways to compete and innovate and grow. So those are the 5 bear market arguments and some added info for you. Now, I'm not suggesting, of course, that stocks will go up forever or that they're immune to volatility. Remember, over and over, we've talked about 4 5% pullbacks on an annual basis. That's normal. And 1 10% correction. Again, normal. But, conditions seem to point towards no serious concern for the bear market, the 20% correction. Corrections are normal. The water cooler wisdom suggesting an impending bear market just doesn't really worry me at this point. We'll talk to you next time.